Hello everyone, I hope everyone has had a restful and relaxing summer, well deserved. I know we all needed it, and I figured that this would be a good opportunity before we get back in September to do an updated TDA video. So I want to give you guys this gift before everyone gets bogged down when school starts up again. Today, we're talking about New York State's TDA or 403B program. It's very similar to a 401k, and if you know other people, even if they're outside of the city that are eligible through their employment for either 403Bs, 401k, it's all very similar. The principles are largely the same. So today I just want to give you guys a quick overview of what the TDA is and why you should invest in it. What are some of the advantages of it, how it works, money you're putting in with taxes, and when you're allowed to withdraw. And then stick around to the end where we're going to get to the fun part, which I focused mainly on in the last video. Once we look at your different investment options with what you can put your money in through the TDA, you're probably familiar with the 7% fixed return option, which is great. Beats leaving that money in any bank where you're getting 0.001% maybe. And I'm going to show you guys what is possible with this TDA thanks to the power of compound interest and how we can all hopefully retire millionaires. So let's get right into it. This video is not financial advice. Please do your own due diligence. Speak to a financial advisor or a professional before making any investment decisions. My goal is just to educate you and show you what's possible today. Yada, yada, yada. All right, so 403B, 401k, and by the way, share this with anyone you know, like I said, who is eligible for a 403B, 401k, any type of retirement plan through their company. They're highly beneficial. You can really set yourself up and your family for a future full of money. And you've definitely worked hard these last couple years, I know, so everyone deserves this. First off, let's start with what's the difference between a 403B and a 401k. New York City DOE, we have a 403B, which is usually for, public companies. 401k is usually more in the private sector, but they are largely similar. For today's purposes, they're pretty much the same. So what are the advantages of 403B? If you opt for a traditional 403B plan, you don't pay taxes on the money. It should say you contribute until you begin making withdrawals after you retire. So you will reduce your taxable income. I'll explain all this in a second. And it also helps you because in retirement, obviously most people have less income at that point. So you fall into a lower tax bracket. So when you start taking that money out, you're going to pay a lot less money in taxes, most likely, if you do it in, let's say, smaller increments as you need it instead of in one lump sum. So really quick, let's look at the TDA program summary. And if you all find value in this video, please share it with family and friends, anyone you think who could benefit. Subscribe to the channel if you're into this kind of stuff for more. TDA is an excellent way to save additional money for your retirement. The TDA program is an optional investment available to all TRS members. So it helps you to invest money for your future on a tax-deferred basis. So by contributing, you may reduce your taxable income and your current tax liability. So let's just say you're making $70,000 a year and you put 0% in your TDA, you have $70,000 of taxable income. Well, let's just say you contribute, let's say $5,000 of that salary into the TDA. Now you only have $65,000 in taxable income. So it helps you in the sense that you end up paying less in taxes, and especially over the long run, this really adds up. So you get to keep more of that hard-earned money, and you're going to put that money to work for you. So you will not pay any taxes on your contributions or your earnings until you withdraw your funds. Now this is one way this, 401ks, 403bs, and regular IRAs, all these retirement vessels differ from a Roth IRA. If you're interested in that, I've made videos on it. Check out the channel. But with a Roth IRA, your contributions are not tax deferred. You pay the taxes on it up front, but then it grows tax-free. So that's a topic for another day. You're still ahead of the game with this though, because as I said, you're saving money in the present, you're paying less taxes, you're just gonna pay the taxes down the line, but hopefully at that point you have a lower income, so you still will end up paying less taxes. Some benefits of the program: flexibility, convenience, loan availability, and it's easily accessible online. So I'll link all these documents in the description below. I'm just gonna skim through it today, but there's instructions here on how you can sign up. Now the TDA is not the same as the qualified pension program. Two separate things. Put in the required amount of years, you get the pension. The TDA is just an optional bonus that you could use to put away money for retirement now and hopefully have that money grow a substantial amount. As far as contributions go, the limit for 2020 was $19,500, and as far as I know, you can only contribute directly via your paycheck. So that's another thing that I like about it, is that it doesn't even feel like you're losing the money because it comes out of your paycheck before you get paid. So it's not like it hits your bank account and then you're losing your contributions. So it hurts less, to me at least. So there's several different funds you can choose from. So you're gonna put your money in the TDA, and from there you can choose which funds you would like to allocate your money to. The fixed return fund is very popular amongst many of the people I've spoken with. They prefer to use that. And this all depends on your strategy and your risk tolerance and how far you are from retirement. But at the very least, the fixed return fund is a great place to start. It gets you an annual rate of 7%, and for as long as the earth is still spinning and the DOE is not bankrupt, you will get 7% a year in interest on however much money you have in that account till the end of time. But stick around to the end of the video. I'm going to show you guys the other funds and how I think you're selling yourself short over the long term if you're just putting all your money in the fixed income. The other thing that's nice is you can allocate percentage-wise. You could put 50% in the fixed income, 50% in another fund. We'll get to all that in a minute. So again, I'll link this document down below. You guys can read through this on your own time. Hopefully you have some time before school starts up again. So here's a model. It shows you if, let's say you make $58,000 a year, you contribute $3,600 into the TDA. Now you only have $54,400 of taxable income. So you end up paying almost $1,000 less in taxes. You get to keep that money. It's just obviously some of it is in the TDA that you aren't going to be able to touch until you're 59 and a half, unless you meet one of those exceptions outlined above. So this document outlines how to set it all up. Now let's get into the fun part. Let's take a look at some of these funds that you can invest in and how they've performed over the years. Example they give you, I'm going to link this in the description below as well, how compounding interest helps your account and your money grow over time. So this shows you that after 5 years, if you contributed $6,000, that's equivalent to $100 a month, and you'd put it all in that fixed income return where you're getting 7% a year, it would grow to a little over $7,000. Fast forward 20 years, you would have contributed $24,000, but what you would have sitting in that account would be double, $50,000. That's thanks to the power of compound interest. When you account for that 7% interest you're making every year, compound interest is a beautiful, magical vehicle to get you to where you want to be financially. Here's some more information from the TRS website real quick before we get to the funds themselves. Don't wait to start on that retirement nest egg. Time is your best friend or your worst enemy. The longer you wait, the less time your money will have to compound. And over long periods of time, it's going to compound into a significantly higher lump sum. So start reducing your taxable income today after you speak to a financial advisor or a licensed professional. Just pretend I don't know what I'm talking about and start small. Even if that means, look, I know New York City is expensive. We've all been through it. Even if you start with 1% of your pay in the TDA, this will start adding up and you'll be happy when you look back. And then over time, as you get a raise each year or you hit those new pay steps, you can up that percentage and then you're really going to get the ball rolling here. So let's look at these fund profiles and then I'm going to show you guys a compound interest calculator and we'll call it a day. All right, you still there? You still awake in the back row there? There's the important part, wake up. All right, so this is as of 2019. We got the fund profiles here. I'll link this as well below. So the fixed return fund, you get 7% a year. Simple, no matter what, whether the markets go up or down, 7% a year. Solid, but wait, the diversified equity fund here, which basically just tracks the stock market. If we zoom in on the fund performance here, you will see its annual rates of return. 2019, 7%, 2018, 12%, 2017, 18%. So those 3 years, it far outperformed the 7% fixed income you would be getting. Now, yes, 2016, it was a down year. You lost 0.62%. But as you can see, over the long term especially, there is a lot more going up than there is going down. So if you were to take this, you added all these numbers up, you're getting a much, much higher return than you would be with that 7% annually. And again, the beauty of this is you don't have to put it all in diversified. You don't have to put it all in fixed. As you get closer to retirement, it is wise to start transitioning over to fixed. But if you're someone young like me, or even if you have 15, 20 years to go, wherever you are in this journey, you can put some in diversified or these other funds. You can put a small percentage too. You can put 80% of your money into fixed, 20% into diversified. That way you can sleep easy at night. That's all for you to figure out with your professional financial advisor. All right, remember, don't listen to me. If we continue here, balanced fund, we'll skip this. Why would you put money in the balanced fund if it's making worse return than the fixed? International equities, okay, it's a little bit volatile, but again, you can put a few percentage points in there if you want international exposure. Inflation protection, again, lower than the 7%. Why would you do it? All right, sustainable. This is one I really like, especially in the current climate. We obviously have a huge climate crisis going on, and there's a big emphasis on shifting towards sustainability. Now, this fund's performance, I would love to see how it did in 2020 and, so far this year, because I'm sure it's just like this. This fund, the last 3 years, you're averaging like a 20% return. That's insane. That is better than Wall Street professionals can do. Find me a Wall Street professional who can get 20% returns annually over a period of years. It's hard to do. Obviously, this one has fluctuated a lot. Some years it got 7%, 5%. 2011, it got 38%. So again, with the non-fixed fund returns, this is in no way indicative of future performance. It's just to give you an idea of what's possible. And if you think that we're going to continue down this, trend of sustainability, I personally would put some money in sustainability because it's a no-brainer to me. So my TDA, actually, I have 50% diversified, 50% in sustainability. Now, I was in the fixed income at first, and then one day I took the red pill when I was offered a red and blue pill, and it has made all the difference. So hopefully this continues. Like I said, that's all stuff for you to figure out with your financial advisor. Do your own research, figure out what your level of risk tolerance is and how close you are to retirement. So those are the main ones I want to focus on. And again, there's this US equity fund as well. You can look at the different funds. I'll link this in the description below. So, exit ticket. Actually, no, before we get to the exit ticket, sorry, this lesson plan is all over the place. I'm not sticking to my time frames here. Please do not give me a bad rating. So we're gonna open up this handy dandy little compound interest calculator here, right? Let's just say you're starting at 0, right? And let's just say each year, I think the model they gave was around 5,000 you're gonna contribute annually. Let's just say 20 years out. And let's say, if you do a mixture of the fixed and the diversified sustainable, maybe you can average a 10% return, right? How much money you end up with? 315 grand. All right, not bad. So that would be, you would have put in 100,000 and tripled your money. All right, let's see, what about over 30 years? Now you'd have almost $1 million. And this just goes to show you how important time is. The sooner you start, the better. The longer you wait, because look, if we only compound this over 2 years, you're not making much money. The compounding really starts to add up further down the line. And let's also compare, 20 years down the line. So at 10%, you would have 300,000. If you are only doing the fixed income, you would only have 219,000. So it's still great, don't get me wrong. And if it helps you sleep easy at night, I understand. But talk to your financial advisor, see what they think over the long run. Now let's just look at if you were to put the max in, which the max you can contribute is $19,500. I know it's a lot of money, but let's work our way up to that. Whatever you could start at is better than nothing, and you can work your way up as you get raises. Years to grow, let's say 20, interest rate 10%. You would end up with 1.2 million over 25 years, 2 million, and over 30 years, 3.5 million. So how would you like to retire $3.5 million? Does that sound good to you? Even if we have that, let's say 10,000 a year, and if that means right now you're only contributing 3,000, but maybe later on in life, your expenses are lower, you're making more money when you're on the max salary, so you could average it out to 10,000 a year, still end up with 1.8 million, not too bad. So your homework assignment, exit ticket homework, I want you to sit down and figure out realistically how much money you can contribute to your TDA and set it up immediately after talking with a financial advisor or professional or doing your own research. I don't know what I'm talking about. Forget I said anything. If you enjoyed the video, if you learned something today, please don't forget to like, share it with your friends and family. It would really help out my channel. And subscribe if you're interested in learning more neato little tricks like this. Hope everyone enjoys the rest of their summer, and let me know if you have any questions.